Hi, thanks for joining us. My name's Matt Bushby. Today I'm with the ClearBridge Global Infrastructure team. With me is Nick Langley, Portfolio Manager across all ClearBridge Global listed infrastructure strategies. And we're going to be talking about why net zero is a positive for infrastructure investing. Nick, thanks for joining me.
Pleasure.
There's a lot of countries that have been signing up, the pledge to net zero emissions by 2050 in order to limit global average temperature rises to 1.5 degrees Celsius. Why is the discussion often around infrastructure and its pivotal role in this path?
As we move toward net zero, we obviously need to take a lot of or reduce emissions that we generate as a global economy. And about 60% of those emissions are energy or the transport and uses of that energy. And that all relies on infrastructure to occur. So infrastructure is going to need a phenomenal amount of investment to help move us along that path toward net zero over the next 30 years.
You just said phenomenal amount of investment. Can you quantify that for the audience?
Well, that's difficult because some of the investment will be in technologies that not yet operating at a commercial scale. But we are talking huge numbers, in excess of US $75 trillion in today's dollars over the next 30 years. So this is going to be a massive tailwind for infrastructure and infrastructure companies, as I say, over the next 30 years.
Let's come back to that tailwind aspect in a minute, but the year 2050, it seems like a long way away. Are there certain things that have to be done quicker than others, or nearer term milestones that we really should be thinking about right now?
Yeah, listen, the global leader on this is the International Energy Agency. It's backed by 30 developed nations and another 8 emerging nations. And they've recently published a report on what they consider to be the most pragmatic path to net zero. And essentially they say, well, today we emit 33 billion tonnes of carbon dioxide. Over the next 10 years, by 2030, we need to get that down to 20, and then to 10, and then to 0. And this next decade is really important from a policy perspective. Governments need to get together. They need to get some coordinated global policy to help identify the appropriate energy mix for each country around the globe, because it is going to be different. But that first stage of development over the next 10 years is we've got the technology to be able to achieve that. Where we've got issues is in the 2030s and the 2040s. There's a lot of innovation that needs to occur for us to be able to achieve those targets.
Let's turn back now to that investment required. Why is investment like this considered a tailwind for infrastructure investors?
The way infrastructure companies make their money is a return on their asset base. And so, regulators will say to the companies, we want to achieve these goals. What projects do you need to do to be able to, get to, say, 50% renewable energy in the energy mix? And the companies will say, well, we need to put in place, these solar farms and these wind farms. As the regulators sign off on those projects and the companies then execute on those projects, the cost of those projects goes into their asset base. And the regulator will say, I will give you this return on the asset base or the equity that you own in that asset base. So broadly then, as we move along this path and we undertake this investment, the asset base of these companies is going to grow. And assuming the regulators are providing appropriate and steady returns, which they have been doing over the last few years, then we're going to see growth in earnings, growth in cash flows, and growth in dividends for these companies.
Clearly, that's a positive for infrastructure investing. Back to the numbers, you mentioned an astronomical number earlier. Is all of that investment going into the types of assets that we would consider infrastructure at ClearBridge?
Yes, big picture. And again, some of those numbers are a little fuzzy because some of it's technology that doesn't yet exist. It's kind of a 30-year number. But if we really focus in on core infrastructure, say the poles and wires companies and the the companies building renewable energy sources, those names will be spending something in the order of $50 trillion over the next 30 years. And today they're spending something like $700 billion a year. So there's going to be a significant step up, a tripling and more of the amount of expenditure. And we need to step up that expenditure really this decade. So what we're going to see is an increase in the trajectory of the growth of these underlying asset bases. And with that, an increase in the earnings and the dividends and the cash flows.
Two follow-up questions to what you've just said. The first one, you mentioned core infrastructure, the pipes, the poles, the wires, the transport assets that we typically invest in. Why is it important for investors to differentiate between those type of assets that you might find in our portfolios, as opposed to, say, the technology and the manufacturing of turbines and solar panels that potentially get used sort of in the infrastructure itself? So what's the difference between the two from an investment perspective?
From our perspective, it's a risk-return proposition. So we are trying to deliver a core infrastructure return, high single-digit, low double-digit, great downside protection, good upside capture. So we want assets that are not volatile, that have stable cash flows over time, and have regulators or concession contracts that are backing those revenue streams, so there's low risk to us as an investor. If you start investing in some of these technologies, these innovations, think green hydrogen, think new types of batteries, carbon capture and storage, and so on. Listen, the people who crack those technologies at a commercial scale are going to make a lot of money, but there's a lot of risk associated with that, and that's not something we want for our portfolio. We are down the fairway, steady returns, ballast for client portfolios.
The second question I had is, we've talked a lot about the net zero impact on the power sector, and utilities are an obvious example, as are renewables. What about other traditional infrastructure sectors like transport? What impact is the path to net zero, likely to have on them?
Well, as we think about transport, obviously, electric vehicles are going to be key to that going forward. The International Energy Agency has a target that by 2030, 60% of all vehicle sales will be electric vehicles, and so we need a substantial rollout in EV charging infrastructure. But if you're a toll road, it doesn't really matter whether it's an internal combustion engine vehicle or an electric vehicle that travels on your toll road. Actually, as we move forward into autonomous electric vehicles, that will, at the very least, quadruple the capacity of today's toll roads. And what that means is that if we go forward maybe 10 years, we're not going to see a whole lot more new toll roads being built, but our existing toll roads are going to be worth a lot more because they'll have more traffic on them.
Clearly much to be excited about with the investment required. It does also potentially impact negatively some assets. Think about midstream assets potentially. There's a lot of talk about the carbon emitted from planes, for example, and obviously they land and take off at airports. Can you comment on that?
Yeah, listen, there will be some losers in this process, and it's going to be quite tricky to discern winners and losers within certain sectors. Pipelines are a great example. Today pipelines transport natural gas, right? In the future, they'll be transporting hydrogen, green hydrogen. Some pipes will be able to be re-sleeved and reused. Other pipes will become stranded assets and will have to be written off. Generally, we think that the transmission pipelines, which are the high pressure pipes that cross state boundaries and so on, will likely survive and will be used on the hydrogen. But as natural gas is used less and less, there's certain basins that will essentially shut down, and any transport, gathering and processing plant in those basins will essentially be stranded assets. Similarly, on the airport front, it's very uncertain as to how passenger trends are going to come back post-COVID. Business travel is obviously going to be down. We've got governments that are trying to move people off planes and onto, say, high-speed rail. Europe's a great example of that. And so the growth in passenger traffic over time is a little uncertain. And that's one area where, if you're in airports today, it does make sense to consider a listed option with the liquidity and the ability to move your investments around over time.
So Nick, clearly opportunities today, potentially other opportunities into the future. Do you see the beneficiaries of that path to net zero changing over time?
That's a great question, and the beneficiaries will change over time. And one of the ways we're thinking about this is following public policy, which then rolls down to regulators to implement that policy, and essentially companies and us as capital to help execute on the projects. The path of public policy is going to change over time. So right now, it's all about building as many renewables as we can, building out poles and wires, building out EV charging, electric vehicle charging infrastructure, and the like. As we move forward into the 2030s, we're going to have a lot more work around things like green hydrogen, which we've discussed, and the pipeline companies are going to have a lot of heavy lifting to do then as well. We'll have electric trucks, EV trucks, and likely autonomous ones. So we're going to see a lot of work in the rail space with them pushing their intermodal terminals deeper into their networks. And so there's a whole series of opportunities that are going to unfold over time. And the trick for infrastructure investors, again, thinking about core returns and so on, is going to be focus on where the public policy is going, invest with public policy, and look for regulation or concession contracts to back revenues from these new projects to reduce emissions over time.
Nick Langley, thanks for joining us today.
Pleasure.
The path to net zero is absolutely critical, and infrastructure will, of course, play a pivotal role. There are literally trillions of dollars of investment that need to be made over coming decades that will underpin our returns and provide a tailwind for infrastructure investors for decades to come. However, liquidity and flexibility in portfolio construction will be absolutely crucial to both capturing the opportunities but also managing the risks as we navigate the path ahead.